Hi there, and welcome to Inside the Paddock, episode 6, where we'll be talking about unsecured finance. So, what is unsecured finance? Well, effectively, it's any sort of finance that is not taken out with direct security over an asset, so a building, a vehicle, or a piece of machinery. However, the term is ever so slightly confusing because it's not completely unsecured. Technically speaking, what most lenders will do, and in 99% of cases, they'll take what's called a personal guarantee from either a director or shareholder. More on those in another video. But what does that look like? Well, what it means is that you are, to an extent, personally liable for that loan as a director or shareholder should you take it out. Now, that's to ensure that the lender has the ability to recover should everything go wrong, because if it was completely unsecured, there would be no real rationale behind a business ever wanting to pay it back. So, what does an unsecured loan look like? Well, an unsecured loan typically looks like a term loan, such as you'd get from your bank or building society. It's maybe over 2 years, 3 years, 4 years, 5, and you have a mixture of capital and interest repayments on a monthly basis, typically on a fixed monthly repayment amount. Now, who are the lenders in this space? Well, in the kind of outside the banks, you've got Funding Circle, you've got Lending Crowd, you've got Fleximize, iWalker, and plenty of others in the space as well. Now, what's it cost? Well, in terms of cost, as you can imagine, because it's not being secured against an asset that can be recovered, an unsecured loan is a little bit more expensive than the likes of your asset finance, commercial mortgages, for example, or even your personal mortgage. So average rates tend to sit between 12 and around 25% at time of recording. Now, I've had a couple of clients come to me and say, well, Alex, this looks a lot more expensive than what I'm used to paying on, say, my personal mortgage. And it absolutely is. And the reason behind that is because on your personal mortgage that may be at 4 or 5%, the bank has security there. They have the property you're living in. And if anything were to go wrong with that mortgage, they would reclaim your property. Obviously, that's not quite the case on an unsecured loan. When's it useful? Well, it's really useful when you need to spend money on things that aren't tangible in terms of an asset, a vehicle, a piece of machinery. So things like hiring staff, marketing costs, etc. That is when unsecured finance becomes particularly useful. And the big advantage of not having security is that it tends to be a hell of a lot quicker to put in place. So most of these lenders will be able to put funds in place within 48 hours, with instant decisions in some cases. Thanks for listening to the first in a series of chats around different types of finance, and we'll be back next time.